Hello, I'm Smits for the Capital Network, and joining me today in Sydney at Westpac Banking Corporation is the bank's Chief Economist, Bill Evans. Bill, wonderful to speak with you here.
Yes, great to be here again, yeah.
Westpac is Australia's second largest mortgage lender. What is your outlook for property this year?
Well, we think this year will be a much quieter year than the recent years that we've had. If we think back over the last 12 months, Sydney prices and Melbourne prices were up around 11 to 12%. Brisbane by about 4 or 5%, and prices fell in Perth by 4%. I think next year, Sydney and Melbourne and Brisbane will all be in that 0 to 5% range, whereas in Perth we are concerned that we will see further falls.
You mentioned Sydney and Melbourne. Sydney has traditionally been the stronger of the two. Recently, Melbourne's been catching up. Is this a trend that you also see continuing this year?
Oh, look, I think both of them will have fairly quiet years, but I'm certainly not in the camp that says that the weakness that we've seen in the final quarter of last year, which was in response to 2 interest rate increases for investors and 1 interest rate increase for owner-occupiers, and some restrictions on the availability of credit to investors. And I think the impact was a fairly a sharp correction to prices in both Sydney and Melbourne in that period. I don't see any more interest rate increases or restrictions in those terms continuing to next year. So I think next year will be more of a stable year. But certainly the days of the double-digit price increases in those 2 cities, I think, are behind us. So I wouldn't expect to see too much price differentiation in terms of appreciation between Sydney and Melbourne next year.
Generally, that's a fairly muted outlook, but might there be any bright spots across Australia, areas that might defy that muted trend?
Well, I think the 2 other cities that we look at very closely are Brisbane and Perth. Brisbane has lagged Sydney and Melbourne in this particular cycle, and I think if we look at affordability measures, Brisbane stands up pretty well at the moment. So I would expect that Brisbane might do a little better than the 0 to 5% increase that we're thinking about Sydney and Melbourne. Maybe Brisbane will be in the upper end of that 0 to 5% range, and the others might be nearer the middle. We are concerned about Perth. We've seen price falls this year. And there does appear to be a lack of demand there, given that city is the one that's been most adversely affected by the downturn in mining. So if I was to be worried about one particular city next year, it would be the Perth city.
And now, final question, Bill. Everyone loves your interest rate outlook. At the beginning of last year, you correctly predicted that we were going to be at 2% at the end of 2015. We're now at the beginning of 2016. Where do you see the key cash rate ending this year?
Look, markets are expecting the Reserve Bank to cut rates by 0.25% at some stage by around May, June. That's possible. I'm certainly not dismissing that possibility, but at this stage, my central view is that rates will be on hold for this year.
So we'll be ending the year at 2% as we started.
At a boring 2%.
Okay, well, it certainly hasn't been boring today. Thank you so much for your insights for the Capital Network.
Thank you very much.